Hello everyone, welcome to Afsara 24/7. My name is Niharika Walia Bhatnagar and I am with you with the specific area of ABFM, that is Advanced Business and Financial Management. I hope you're all doing fine, everyone. Okay, good morning and please share the session, like the session, and don't forget to subscribe to the channel if you haven't done it yet. Chaliye, let's begin with the session, everyone. What am I going to talk about today? We were discussing capital budgeting, so I'm going to discuss concept of the day with the specific case study. Okay, so please pick up your calculator so that I can discuss both the question as well as the further detail of it. Okay. Chaliye. Let's begin with this part, everyone. We're talking about capital investment decisions. What do you mean by the term capital investment decisions? The decisions that we take in terms of buying an asset, investing in one asset or the other. When we are determining these things, then that is covered here. Done? Let's talk about this in detail. What is the concept of the day? Let's talk about the concept of the day, everyone. What's the concept of the day? In the last class, I talked about payback period. Do you remember that part? In this case, I'm going to talk about another non-discounted method, not the discounting one, non-discounted method. Chaliye, let's talk about that method as well, everyone. Concept of the day today is accounting rate of return. What is the return that you are getting in the business? Obviously, every business wants to know what is the amount that they will get in return. If I get a good return only, then I'll put money into the business. Now, practically, that is where we do that. Otherwise, why would I put money into something? This part is called accounting rate of return. If you look at the area of accounting rate of return, this is the formula which reflects your rate of return, whatever your return you are getting because you invested money in this, right? You are compared to the initial investment cost. Now, this method involves estimating revenue and expenses for say over 3 years and to find out the average rate of return which can be considered as the rate of appraising the investment. You're going to increase the investment further now. If I say that I want to increase my investment, I should be getting enough money so that I feel motivated ki, "Arey, nahi, I'm getting good money from this business already. I think I should invest more." That particular thing comes out of this area only. Now look at this. Accounting rate of return can be defined as your average annual income divided by investment. If your income on an annual basis is 1 lakh and you invested 10 lakh rupees, then you give it in percentage. That is your 10%. This is how you define the specific area. Done, everyone? This is how we define the accounting rate of return. Higher this particular return, then that particular thing would be chosen up. Reason, you get more returns, so you definitely look forward towards that particular area altogether. Okay, let's look at the next point. This method scores over the other methods because this is a little better method. This is one of the best methods. The discounted cash flow method calls for estimates for the entire project. Payback period just looks at the period in which we can recover funds. This method takes over overall whatever money you're making. We find many assets outlive the rated life. There are certain assets which are beyond that particular area even. This is better than discounted one even. In the longer run, in the books of accounts, if you see good money, then only we can say na. The estimating money is basically you're just calculating it. Ki maybe this would be the money, maybe this won't be the money. This can turn out to be unreal. And this method uses a limited data but is based on accounting information readily available and familiar to the business community. And everyone, now let's talk about the next point. These are the basic reasons why this method is better. Acha everyone, pick up your calculators because now we're going to do a specific question from our book itself. How do they deal with this specific issue altogether? Done? Okay. So let's talk about this topic in detail. Done? Now look at this question. Suppose A Limited is going to invest a sum of 3 lakh rupees having a lifespan of 3 years. They have a lifespan of 3 years and their salvage value is 90,000. Matlab 3 lakh is the value of the asset minus 90,000. That is what you are getting out of it. The profit before depreciation for each year is 1,50,000. Matlab you earn 1,50,000 as your profit before putting the depreciation. How do we calculate depreciation, everyone? Cost minus salvage value divided by number of years. That means you have 2,70,000 as the depreciation total. Divide by 3 years, that means rupees 90,000. So in this case, it is going to be profit before depreciation is 1,50,000. You are getting 1,50,000 as profit before depreciation. Now in this case, oh sorry, this is 2,10,000. This is 3 sevens are 21 and you get 70,000 here. Hai na? Acha, look at this. I hope this is visible clearly now. You have got 3 lakh minus 90,000. The formula that I used was cost minus salvage value divided by number of years. 2,10,000 divided by 3 giving us 70,000. The profit after tax and value of investment in the beginning and at the end of the each year is going to be this. Depreciation charged, profit before depreciation was 1,50,000. From this 1,50,000, remove your depreciation. What you're left with is profit after depreciation. Once you have got the profit after depreciation, then they say what is the value of the investment. This is given. In the beginning we had kept 3 lakh rupees, then it became 2,30,000 after depreciation, then it became 1,60,000. By the end it is just 90,000. That is the point that they're saying. For the first and second and the third year, the depreciation is 70,000 for each year. So if I put 3 lakh into something, by the end it is just now at 90. Now there are different versions of calculating it. One part was your profit divided by your initial investment. In this case, we do it slightly differently. This is annual basis. What do you mean by annual basis, everyone? We're just making it every single year, it's going to be different. That is profit after depreciation divided by investment in the beginning of the year. That means you pick up your profit after investment. That means what you're going to pick up? 80,000. This is your 80,000. For the first year, you have 80,000 divided by what is the amount of money that you have invested? 3 lakh. In the second year, it is 80,000 divided by 2,30,000. In the third year, it is 80,000 and divided by 1,60,000. What are they picking, everyone? They are picking the investment value in the beginning of each time that they're picking up. That is, beginning is the investment data that they're picking up. Beginning is 3 lakh, 2,30,000, and the last one is 1,60,000. Visible, everyone? Now let's look at the next part. This is 80,000 divided by 3 lakh, 80,000 divided by 2,30,000, and 80,000 divided by 1,60,000. Find the percentages as well. First is 26.67. What have they done? They took the profit after depreciation divided by beginning wala portion and they multiplied it by 100. That is why it is in percentage. First year, second year, and third year. This is individual. Done? This is the first method. Now look at the next method. This was the first version. Second version to it is version 2. What do you mean by the second version, everyone? They are taking not this part. Now they say, we will not take up individual years. Let's take up all the 3 years together. That means total investment basis. Total investment basis means take up your total profit and total profit converted into average, and then divided average annual profit divided by only the investment in the beginning. How do we find the average, everyone? It is going to be 80 plus 80 plus 80 divided by 3. That means my average investment is of 80,000 and divided by the initial investment that you have made, that is of 3 lakh rupees. So this would be 80,000 divided by 3 lakh. Acha, writing it over here now, everyone. 80,000 plus 80,000 plus 80,000 divided by 3. That gives us total 2,40,000 divided by 3. Again, the amount comes out to be 80,000. That means the value is 80,000 overall. You pick up that 80,000. This is your profit. Profit divided by 3. Okay, total profit divided by 3 and divided by 3 lakh. That is your investment in the beginning. multiplied by 100. This has to be in percentage. Accounting rate of return is always in percentage. Everyone think about it. Here we had seen that good point here, but I think if I go by the third year, I am just investing 1,16,000 getting 80. But where's the depreciation consideration? It should be there now. So in this case, first year we had 26.67, then increasing it to 34.78, increasing it by another good percentage, it is turning into 50%, huge amount. Total investment basis, it is average annual profit divided by investment in the beginning. You've got it, and it comes out to 26.67%. Done. Now let's move on to the next point. Okay. Let's move on to the last version. The last version is your average annual profit divided by average investment. Everyone, whenever we are trying to find average, normally na, average investment is opening investment plus the closing investment divided by 2. Matlab I could have taken 3,90,000 divided by 2. But the point is, in this case, we have it as a salvage value. It is the residual value which would be left after 3 years of using it. It would be of 19, we'll sell it off. In this case, what will we do? We will use the term half. Then whatever your initial investment is, you spent 3 lakh, yes. Then whatever your salvage value, whatever you'll get after 3 years, plus the salvage value. You will get this much amount of money, and you are taking the average of whatever money your investment is into the business for all these 3 years. You said you are putting money, you spent 3 lakh rupees. From that 3 lakh, remove that 90,000 that you will recover in any case. You have spent 3 lakh into this and you will recover 90. So technically your amount which is staying invested is 2,10,000 only. Then 90 is something you will definitely get back. So your total investment is what? 1 lakh of half of 2,10,000 plus 90,000. That makes a total. It is 2,10,000 divided by 2, 105 plus 90, making it 195. If the total is 1,95,000, then 80,000 divided by 1,95,000 into 100, giving us 41.03%, everyone. This is the one. See, in this case, I think I can see the maximum price, a maximum accounting rate of return. Done. This was the concept of the day, a specific question on accounting rate of return. Chali. Now everyone, put an end to the session, but before I end the session, there are certain things that I would like to discuss. Hello everyone, welcome to episode 24/7. My name is Niharika Walia Bhatnagar and I am with you with the specific area of ABFM, Advanced Business and Financial Management. How are we doing, everyone? Today we are going to talk about the capital investment decisions. Everyone, in the last session I've covered the specific area of accounting rate of return. Today I'm going to talk about the next topic. So before we proceed further, everyone, just let me know if I'm audible as well as visible. Everybody, today we'll be learning about net present value, or also known as NPV. That's the concept of the day. as we were talking about NPV, capital investment decisions, I've talked about different methods altogether. So I'm going to take up another method today. Let's learn another method. What is the concept of the day today? Net present value. Acha everyone, if these sessions are helpful to you, then please go ahead and like these particular sessions. Help me out, be there with me in these sessions, and not only be there but also motivate me by sharing these sessions, liking these sessions, and also looking forward towards the upcoming classes as well. Okay everyone, let's understand this topic altogether. How do we define NPV everyone? This is an NPV. What do you mean by net present value? Net present value means the present value of the cash inflows and the present value of the cash outflows. What do you mean by present values? As you already know, when we talk about present value is something which I can say is because, see, if I tell you that I'll receive 15,000 rupees in the upcoming future, how does it make sense? In the upcoming future, say after 10 years, if I'm receiving 15,000 rupees, today only 15,000 is not a very big amount. Receiving 15,000 in the upcoming future, will it make a big difference? I don't think so. Hai na? So the value of the money will definitely fall further, isn't it? That is how we define this specific area altogether. That is, present value of the particular thing has to be considered. When we talk about NPV, how do we define NPV? The difference between the present value of the cash inflows and the present value of the cash outflows. This is a situation that you have your initial investment is taken. From the initial investment, you find the PV of your inflows. Say, if I receive 15,000 in the upcoming future, the present value today is say 10,000. And my initial investment was of 8,000. So if I would have received this 10,000 today, I would have invested 8,000. That means hardly 2,000 rupees is there, but this is positive. I am having a profit in this scenario. Having a profit is good or bad? It is always good. So in this case, if you have your NPV, net present value, being positive, then you accept the scenario. If it is negative, then you reject it. That's how we define the term NPV, everyone. Net present value uses the basic thing of it uses the specific area of compound interest. Do you remember how do we used to calculate this compound interest, everyone? We used to calculate compound interest like this. That is principal 1 plus r raised to power n. Your future value was based upon your present 1 plus r raised to power n. If I say that after an year you will receive this much amount of money, after 2 years this is what you will receive, after 4 years this is what you receive. I have a futuristic value 1, 2, 3, 4, 5, 6. What do we do in this case? You take up the futuristic value and divide it by 1 plus r raised to power n. Because you have to find the present value of it. Because what happens is, everyone, if I move forward, interest on interest is received. If I say I will receive a certain amount of money in future, what is the value of it in today? If you move forward, we have a multiply. Can you see this? And when you come back, you have a divide. That is the difference between future value and the current value. Okay? So in this case, when you are sitting on today, this is your future value and this is your current value. Now, let's do this way. My initial investment to my future value. When you move forward, this is compounding. If you come back, this is discounting. Okay? So in this case, either we have compounding, either we have discounting, and on this basis we work. We have cumulative cash flows and then we divide. Done? Let's do a specific question from our book itself, everyone. Chaliye. I hope this is visible in a better way now. XYZ is analyzing expenditure proposal, expenditure proposal for the purchase of equipment. The company uses the NPV to evaluate projects. The capital budget is limited to 5 lakh, which XYZ believes is the maximum capital it can raise. The initial investment and the projected net cash flows for each project are shown below. The cost of capital is 12%. You are requested to do this. Everyone, let's pick up only the first project now. Look at this. The initial investment is this, and in the year you are receiving this much amount of money every single year. Acha. Now the cost of capital is 12%. First of all, whenever you are given the cost of capital, this is what you will use for discounting. That means if I receive 50,000 in the upcoming future, I divide it by 1 plus 12%. First year, then second year, then third year, because this is the value for first year, I want to come back to 0. This is the value for the second year, I want to come back to 0. Third year, I want to come back to 0. Fourth year, I want to come back to 0. Fifth year, I want to come back to 0 year. So every year, if I would have added, now I have to divide again. Well, earlier I have multiplied, now I have to divide. How do we divide it, everyone? Simple basis. Look at this. You pick up your calculator, okay? Whatever calculator that you are using. You pick up your calculator, and then this is 12% now. You pick up 1 divided by 1.12. That means 1 plus 12% gives you 1.12. Now it becomes 1 divided by 1.12. Then click on equal to. Once you click on equal to, you will get the first year. Actually, now in this case, what happens is I'm writing it over here. In your calculator, what you need to do is 1 divided by 1.12. First year, the value will come out to be, when you're clicking on it, 1, then divided by 1.12. This will give us 0.79 and 7. Now do for the second year. Now in this case, you need square of it. That means you have to do the 1.12 ka square and then divide it. No. Just do one thing. You have picked up 1 divided by 1.12. For square, divide it again by 1.12. If you have done 1 by 2 and you have to do it 1 by 2 square, 2 into 2. You have already divided by 1. You divide by another. So in this case, the division can be done by calci again. Once you have divided 1 divided by 1, 2, and you have got the answer of 0.797. So I write 7.797 here. Click on equal to again. In this case, what will happen? You will get next year. It comes out to be 0.711. Next year, it becomes 0.6355. Then comes 0.5674. Every time you are clicking on equal to, the value should be changing. If it is changing, then your calci is the one that you should be using. So the value is changing every single time I'm using it. It's 711, 0.635, 0.5674, and the last year is 0.5063. Okay? So these are the specific amounts that we are having in terms of our PV factors. Now once you have got your PV factors, this is the value that you have to divide. What I did was, I know I have a futuristic value, and I have to divide by 1 plus r raised to power n. The best way is I pick up this and then what do I do? If everyone, a divided by b is given, what if I can have a into 1 by b? Will it make a difference? Your future value remains this only. And what do? Your future value multiplied by 1 plus r raised to power n. In this case, what will we do? We will take up this 1 plus r raised to power n separately. Okay? That is 0.797, 0.711. This calculation is 1 divided by 1.12. That means this part is done. You just have to multiply it by the future value in each case. So first of all, 797 multiplied by 50, 711 multiplied by 50. In this case, it was all the same. So what you do is you do the total of it and multiply by 50,000. You can take it common now. 50,000 can be common. 50,000 multiplied by 0.797 plus 50,000 multiplied by 0.711 plus 50,000 multiplied by 0.635. In multiplication, you take 50,000 outside and you add these all up. In this case only it is possible. Otherwise, everywhere else the values are differentiating. Matlab for all these calculations, you have to do 40,000 multiplied by 0.797, 75,000 multiplied by 0.797. Each and everything has to be multiplied with the individual PV factor. What I calculate for you is called the PV factor. Look at this, everyone. The cost of capital here is 1.12 na. Acha. Oh, one mistake. For the first year, you would have got the value of. For the first year, I missed it out. 0.8928 first year. 0.7971 second year. I'm taking it up to 4 digits. 7117, 0.6355 and divided by 0.5674. What did I do? 1 divided by 1.12. 797 is the second point. Second time when you do it. I actually showed it to the first one now on the screen itself, so I missed it out. So total is this. The GT function comes out to be 3.604. For this, I can do this because all the inflows are same. 3.604 multiplied by 50,000. This will give you the value for the first year. For the first project, everyone. For the first year, if I take it up, the total of all these things would become 216240. Remove that 20,000 and you will get the answer. Other way is they have taken it for 3 digits. I took it for 4 digits. So there's a difference coming up. What they did is they have written all the PV factors. PV factors are multiplied by each and every in cash flows. The cash flows was 50 in the first case. All the 50s are multiplied with these and you are getting the answer. Once you do the total of it, what you have got, this is your initial investment. You reduce your initial investment from this 19,750 and you will get a positive or a negative answer. In this case, if it is negative, this is negative and this is negative. That means you initially put 2,10,000, but the PV factor is having less than 2,10,000. It is 1,90,000, but it is having a negative positive factor. That means you would have spent 1,90,000, but you're getting more than that. In terms of 2,50,000, you're getting more than that. When your NPV is positive, then accept the project. When your NPV is negative, then reject the project. What they did is they found the PV factor. How did they do it, everyone? 1 divided by 1.12. In your calculator, what is the things that you have to click? 1, then divided by 1.12. How did I find 1.12? 1 plus 12%, everyone. That gives me 1.12. You will get the first point as 0.893. Now click on equal to again. Do not press any other button. Just click on equal to. You will get 797. Click on equal to. You will get 0.712. Click on equal to. You get 0.636. Click on equal to again. You get 567. When you keep on clicking on equal to, you will get the answer. Once your PV factors are done, then you multiply it by the project. The cash flows. All the cash flows which are given in the particular area, 50,000, then 40,000, then 75, it has to be multiplied with the respective factor. 50,000 into 0.893, then 40,000 into this, 75 into this is how they had transformed it. 44 to 650, 35 720, 66 95 975 and 66 975. ठीक है ना? Find all these values all together. Then if your total of the inflows is more than your outflows, then you have it as positive. Inflows are exceeding your initial investment, which was of 1,90,000. Done, everyone? Here comes a specific question based upon this specific area. I hope you can try this question. This is a question from the book itself. This is given in our book only. So please go through this question well, and once you're done with this question, then practice other parts. Which of the following statements best describes the concept of NPV? You have seen the NPV. NPV is a measure of total profit from the project. NPV considers both the present and future values. वैसे it is considering only the present value. Future value is taken in a discounted format, है ना? NPV is totally concerned with the cash inflows, or it ignores the time value of money. It never ignores the time value of money. In this case, one thing it is doing is that it is including both the present value and future value. They take up the present future value, convert it into present value. है ना? Done, everyone? चलिए. Which of the following is a major limitation of NPV? It overestimates the cash inflows. It uses subjective discounting factors. It requires complex calculations, or it does not consider initial investment. NPV considers initial investment. It requires many complex points of calculations as well. Then it overcalculates. It does not overestimate, or it does. The correct answer is subjective to discounting factors. Which discounting factor to use is something which is just not known to us, isn't it? That's one part that we just don't know about. So, chaliye, that's it for the day, everyone. If this session was useful to you, then please go ahead and check out our website right away. And I'm with you with the area of ABFM. Okay, everyone, what are we going to talk about today? Today we are continuing with the specific topic further. I'm talking about our victory series. So let's proceed further and talk about a few questions. Okay, everybody, today we are going to talk about sensitivity analysis. What do you mean by sensitivity analysis, everyone? But there are different analysis. Sensitivity is basically how much something can affect you. Can it affect you badly, or it cannot affect you that badly? That is to be covered in this specific area altogether. So in this case, the primary purpose of the sensitivity analysis in a project evaluation is because to calculate the net present value of the project, to identify the factors of impact of NPV, to determine the IRR of the project, or to evaluate the project's profitability. According to you, what should be the answer? Before I proceed further, everyone, please go ahead and share the session among your peers. Don't forget to like this session, and at the same time, subscribe to our channel right away. Along with this, check out our courses as well. I'll be soon starting with another batch of ABFM. So if you're planning to look forward towards ABFM now, then kindly join that specific batch as well. That will be really helpful for you. Till then, What's gonna be the answer? Sensitivity analysis. Chali, when we talk about this specific question, what's gonna be the answer? To calculate the NPV, to identify the factors, or what exactly are we looking forward to, everyone? When we talk about sensitivity, now we are looking at something which is highly sensitive. है ना? Sensitive means which we are talking about sensitivity. Sensitivity means if that particular thing is affecting us badly or not. To identify the factors that impact the NPV. Anything which is affecting the NPV is to be seen. Next question. What is the limitation of sensitivity analysis? When we are trying to study something which is affecting our business, matlab it can be any factor, na? Term, time tenure of the business, number one. Number two can be what? Time period for the particular project, the cash flows, the discounting factor, or that's one of them, na? One is discounting factor, and discounting factor, and there's one more thing left. Cash flows, the change in the cash flows, initial investment. If the initial investment is less, then it is good. If the initial investment is more, then it is bad, है ना? Because you are spending too much and you are always waiting for more money in your future that you could get. So in this case, it provides a comprehensive view of the project risk. It only shows NPV and one variable in the change. Then comes, it is an objective method based on mathematical calculation. And then it is not affected by the perception of decision maker. The answer in this question would be, it only shows NPV and one variable at a time. The difference between sensitivity, number one is sensitivity and second is scenario. The difference between the two is sensitivity takes one factor at a time, while scenario takes multiple factors. Multiple factors changing at one point of time have a greater impact. Chale. So in this case, the answer is it only shows NPV and one variable. Next question. What is the first step in performing sensitivity analysis? What is that first thing that we'll study, everyone? What's the first thing that will affect our business? Conducting an analysis of the project cash flows, identifying the factors of the impact of a project NPV, determining the range of change of each variable, or recording the result of each iteration. See, sensitivity analysis is clearly saying that you should study only one factor at a time. What's the benefit of studying only one factor at a time? I think when we study only one factor, na, that brings a lot of clarity. How does it bring a lot of clarity? Because we know ki how much of one particular asset we are using, or how much one variable is going to affect the utility of that particular project. Whether it's required for a longer period, shorter period, how is it even required? All those things have to be studied now. That is to be considered in this area. So in this case, conducting the an analysis of the project, identifying the factors, what is more important? I think the most important thing is identifying the factors. I need to identify the factors which can impact the project. What is the basis of Hillier model for risk analysis? Net present value, internal rate of return, payback period, or return on investment, everyone? What's going to be the answer? Hillier model is actually based upon which model? The name of this model is by the name of its originator as well. The name is Hillier only. According to his name, it was taken up, and he uses net present value. Even in the international decision making, decision analysis, all these area, NPV plays a very important role. And even in capital budgeting, it plays a very important role. How does it play an important role? Because capital budgeting helps us to understand whether we are getting the money, we are losing money, what's exactly happening with the money, all that particular part. Because net present value considers time value of money. Matlab practicality. If I want to know, if I tell you that after 3 months you might get 1 lakh, you may consider that part. But if I tell you after 10 years you get 1 lakh, you will be like, after 10 years, 1 lakh probably will not be nothing. It will be actually nothing. Not a very significant amount. Today, it might be a little significant. But after 10 years, I don't think that would be. So that's a bad part, right? Chali. So, the considering NPV method takes this part very seriously. Let's see, the value of the thing changes a lot. Done? Chali. Done now? Let's look at the next question now. The next question says a Hillier model measure the risk in cash inflows. Hillier model actually studies the risk in the cash inflows by analyzing the correlation between inflows and outflows, or by calculating the standard deviation, by assessing the volatility of interest rate, or by determining the profitability index. Everyone, what's gonna affect us? Determining the profitability index? No, Hillier model is not looking at profitability index. Then what is it looking at? It is looking at by calculating the standard deviation. What is standard deviation, everyone? Everyone, what do you mean by the term standard deviation? Standard deviation is actually known as the point where we look at the scenario where, see, we have an average. We have an average. When we have an average, then what will we do? If average is 10 and you have 8 or you have 12, in terms of your inflows, it's good if you have 12. But what about outflows? If we are losing, then it's actually bad now. Matlab, I'll always consider it as a bad thing. Why? Because when I'm getting the money in the due course, if I'm getting lesser money, it's bad. And if I'm getting more money, it's good. So if I'm deviating from the standard or I'm not able to make a decision, then things can really affect my business. So in this case, by calculating the standard deviation and the cash flows. In the Hillier model, what is the assumption when cash flows of for different years are perfectly correlated? When things are correlated, matlab if we consider these things and try to find out the values there, na, in terms of correlation, we are trying to find the relationship between different forms of data. You know, if they are basically correlated, then what will happen? What is the assumption? If they are correlated, no risk is associated. No, it is not a risk. The behavior of the cash flows in all these years, it's unpredictable. No, when it is actually correlated, means the data is linked. If the data is linked, then this problem should not occur. Cash flows are similar in all years. I cannot say it's similar. It vary widely in each year. It may vary or may not. What's going to be the answer according to you? The answer to this question is actually, it is very similar in all this year. It won't be same, everyone, but yes, it can be similar. Correlated can be called synced here. ठीक है ना? Next question. What is the purpose of simulation analysis? To create real life situations, to find the optimal decision under various scenarios, to deceive decision makers, or to conduct sensitivity analysis. See, when we have multiple things in our regular life, everyone, I don't think I can say only one variable works at one point of time. We might be hungry, we might be having short of time, we might be sleepless, and we would have been working upon multiple things already. So can you say that only one or the other thing was being affected, or we have multiple things being affected? I would say multiple things are being affected, hai na? So in this case, the answer would be what? To find the optimal decision under various scenarios. What if one thing, other thing, multiple things are being affected? What are exogenous variables? In simulation analysis? Variable controlled by decision maker, variable determined outside the model, variable influenced by other factors, or variable with fixed values. What's going to be the answer, everyone? Exogenous variables, that means external variables which are affecting the organization. That is, variables determined outside the model. Chaliye, let's move on and talk about the next question. What is the purpose of decision tree analysis? But the decision tree is a very reliable source. Decision tree analysis means I said that this is a decision that I want to take, but scenario is this. There's a yes, there is a no. If this is yes, obviously, then two or more situations can arise. Then here also. So if you do something and if you don't do something, both the things are going to affect your business now. What if you do it and what if you don't? In both the scenarios, you're working for the business will change. And if you're working for the business is going to change, then decision tree analysis has to be utilized to represent possible outcomes and associate probabilities graphically. Matlab, you will say 10%, 20%, 30%, it has to be stated with that particular percentage as well. Done. What are the two elements of decision tree? We just talked about decision tree, probability and reward, branch and node, cost and time, decision and uncertainty. In this case, one of the basic things that you do is you have a branch and a node. This is the main branch and this is divided into different nodes. And then this is the branch, then it becomes 2 or more scenarios. ठीक है ना? When we have multiple things, and the things will definitely मतलब multiple scenarios comes out of things. For example, if we study, then what will happen? If we don't, then what will happen? Then if we do the work, then what will happen? Professionally, what growth is available? Multiple points are there. Na? That means we have pros and cons of everything. Right? Chaliye. Next question. What is the optimal decision and decision tree analysis? See, I think when I'm studying a specific scenario, I just have to look at the entire scenario in a detailed format. Ki what things are coming up. The decision with highest probability, nahi. Highest probability, now we need to see the favorability of something. The decision with the lowest cost decision chosen at the starting point of the tree or decision with the highest estimated NPV. Everyone, while taking a decision, what is it that you will always check? मतलब I'll always see what am I making out of it. है ना? So in this case, the decision with the highest NPV. It's not about what can happen, but what do we want is the decision tree analysis. Because obviously, not externally, everything is in our hands. But at the same time, if everything is not in our hands, there are other things which we can control. What if we can control a few things? And if we can control a few things, then why do we take decisions? Just on the basis of whatever can happen? It is always based upon the favorability. That if I take this decision, what favorable situation or outcome will come out of it? Which of the following is an example of controllable risk? Controllable risk matlab the risk which you can actually hold in your hand. You can decide how much you want. Fluctuation in the market price is not in our hands. Political instability, can we control who's going to be the prime minister? An individual cannot. है ना? Multiple people can, but we alone cannot. Then what's the next thing? Changes in government policy is not in our hands. Last is technological obsolescence. Is it in our hands, everyone? What is an example of controllable risk? Controllable and uncontrollable, two separate scenarios. है ना? The answer would be technological obsolescence. That is something which we can still control, but I don't think anything else is in our control. How can market risk be mitigated? By implementing disaster prepared plans, by diversifying the product or marketplace, by staying updated with the latest laws and regulations, by having insurance coverage. Risk can be actually just converted if we diversify it. Diversify it, matlab we give it to someone else as well. That means we are looking into the product, and if one part of the product doesn't work, the other part might. Done, everyone? Chaliye. That's it for the day, everyone. Thank you so much for being there. But before I end my session, have you taken up our courses yet? If you haven't, then what are we waiting for? Chaliye, let me show you our website. And if you're planning, then you can definitely go ahead and look out for our